Okay, I do love a little bit of stability in my portfolio. I do like residential REITs. Everyone has to have a roof over their head. Now, because of this, the stability here is almost unparalleled, perhaps measured or matched only really by utilities. These are really powerful companies for a very good long-term holding if you can buy them at the right price. Two options today to look at. One of these I've talked about a little bit before, but I still think it's really well priced. The other one is a 50-50 residential and other. Now, I think the market's discounting the other side here. Let's have a look at that later, so stick with me to the end and see whether or not this is something that you might find interesting for your portfolio, whether or not this price and portfolio disconnect in this option is giving us a really, really powerful opportunity today. Stick with me. Now, the first company is Essex Property Trust, or ESS, on the stock market. Current dividend yield of 4.4%, BBB plus credit rating, about a 48-49% long-term debt to capital ratio here. Now, as we can see, long-term, the AFFO, I'm looking at the AFFO here, my friends, as it's a REIT, has been increasing up to about 2019, a bit of a dip there, and expected to increase again into the future. Now, as we look at the analyst scorecard, this is what I like to see here. Analyst forecasts for the AFFO 1 year and 2 year out have been hitting it on the mark with a little bit of a beat here sometimes on the 2 year forwards as well. Now, what do I see in the performance? Well, I see the dividend growth. There's been a couple of dodgy years there with some dividend growth that's just been sort of growing fairly anemically in the last couple of years following the pandemic. It's also important to note here that the compound annual growth rate has been lower than the S&P 500, although the total dividends paid has been higher. So here we're talking very much about an income play, and I think if you buy it at the right time, I think you've got the opportunity here for some fairly nice total returns as well. With the forecasting, I'm going to switch it over to the normal multiple here for the price to AFFO ratios. A couple of quick points here. We can see as we look down, we can see that the analyst expectations for AFFO have been decreasing a little bit here, so that's not so favourable. But if we look at the current price to AFFO multiple, if the analysts have it right and the company can achieve this AFFO, we're talking about a total annualised rate of return of about 18% here till the end of the period. And I think that's important to note as well. Now, the second REIT's an interesting one. Now, it's listed technically under Diversified REITs. It's got about a 50% residential, 50% office and retail location. The office and retail locations, I believe, are doing fairly well. The retail is often around service-oriented businesses, so they're sort of Amazon-proof. They're not going to be cut out by deliveries to the home. But at the moment, this type of property is very much out of favour. Now, what this means in my mind is that the company is being sort of punished overall because of roughly one half of their holdings being out of favour at the moment. Now, that means that the price to AFFO ratio here is only about 11.5, and it could potentially be about 20 times if you're looking at Essex or some of the other comparable residential REITs as well. Now, because it is a REIT, I am looking at AFFO here. It is a relatively small company here with $1 billion market cap, but it's also got quite a nice current dividend yield at the moment of 6.85%. Now, if we look over at the analyst scorecard, it's looking pretty good 2 years out and even 1 year out. It's analysts get it right a lot of the time. The company's beating the analysts quite a few times as well. And that's roughly what I like to see. So, forecasting calculators. So, if we look at the normal multiple here, I want to look at the analyst estimates. So, they've been revised upwards fractionally over the last 6 months, all the way out to the 2025 year as well. And if the analysts have it correct here, and prices and earnings return to this 16.3 times level, which I think is reasonable. I don't think that's too demanding. We could be talking about a 70% total rate of return or a 23% annualized rate of return. Now, that is higher than Essex Property Trust, and we're also talking about a slightly higher dividend yield as well, and I think that can be quite attractive. Now, switching over to the performance tab, it's important to note as well that the compound growth rate has lagged the S&P 500, although the total dividends paid have been quite a bit stronger than the S&P 500 index as well. So that's something to keep in mind. Now, this is certainly not necessarily the bottom. I think prices could very much go lower than this. Something to keep in mind. If we look here during the period here in the pandemic, prices went as low as about 8.2 times, suggesting that there's still quite a lot of downside here that we do need to be careful. Okay, so a couple of really interesting options there. Hopefully a little bit of something for everybody. Let me know if you've already got one or even both of these in your portfolio and why you have them. Now, if you don't have them, are either of these options that you might consider? Let me know in the comments down below why or why not. Look forward to hearing from you soon.